Hi guys, hope you're doing well today. Um, we are going to learn today about the different types of investments that exist. We are continuing on our savings and investing unit. Last time, remember, we talked about why to save and we talked about saving for retirement. Today we're going to expand out and talk more about different types of investments. All right, so the first thing that we're going to start with is we need to define what an investment is and what it does. I do want to make sure that you are not thinking of what we talked about last time, which were those types of retirement accounts, as well as CDs, savings accounts, and money market accounts. Today we're specifically talking bonds, stocks, and mutual funds, okay? So one major difference that investing has over savings is that those items must be purchased. They must be bought, okay? So an investment is an asset purchased with the goal of making more money. Now you can make more money with the savings account, but it's at such a low interest rate that it's not technically considered an investment, okay? So investments have the potential for high returns. But on the negative side, they're not as liquid, which you'll learn about later on today. If an investment is liquid, that means it can be turned into cash quickly. Okay, so it wouldn't be a house; it would be more like money in your bank account. And obviously, because we're getting higher returns, there's also more risk involved. Okay, so returns is simply the profit that is generated or made by an investment. Okay, so that's obviously your goal as you're going through having an investment. All investments have some sort of risk. That's very basic. I talked about it earlier. And risk, just like with insurance, is the chance of a loss that cannot be controlled. Now, speaking of insurance, you cannot purchase insurance to protect your investments, with the exception of if you have a house or land or jewelry or something like that. That obviously can be controlled and insured, but stock markets, the bonds that you can purchase, or mutual funds, those are not going to able to be insured. Investments are for longer term goals. So if you remember last time we talked about different goals for savings and investing, these are going to be those long-term goals. Like, my favorite one is retirement, of course, or it could be for a house or for a child's education, something that is a long ways away. Okay? All right, so we're going to continue on and talk about our first type of investment, which is going to be a bond. Now, usually I would make some sort of corny James Bond joke here, but since I'm not in person, I don't think that would work quite as well. But I'm sure you can imagine how great that joke would be. The definition of a bond is when you lend money to a company or corporation or the government for a fixed, or at a fixed interest rate, I probably should say, and it is going to be paid back by the maturity date. So to sum that up, that would be if I gave money for a new school to be built in Emporia. If you guys remember, you're probably pretty little, when Timmerman and Riverside were built, that was due to a bond issue. So consumers could give money, and then the city used that money to build those schools. They were paid back the money that was given plus interest, and it has a set due date that that money must be paid back to you by. Okay, so hopefully that helps explain that just a little bit more. So let's just type out an example here. Let's say that you gave $1,000 on a 5-year bond at 5%. Okay, so that means that you would get $50 every year on interest and your $1,000 back at the maturity date. So it's a pretty good investment. For one, you get to help out either a business or the community for doing something that they want to do, as well as it's a safe type of investment. There's not a lot of risk here, which is what we're going to talk about next. Now, if you've ever heard of a savings bond, those are great grandparent gifts that they love to give. Those are also part of the bond family. Okay, so that's pretty easy for you guys to think about. The great thing about savings bonds is those are actually purchased for half of what they're going to be worth, and that's why grandparents love those. So if you were given a $50 bond, that actually would only cost whoever $25 to purchase, but you have to keep it for so many years until it is mature. So again, lots of different types of bonds that do exist. The risk level with bonds are, of course, going to be a lower risk because there is, oops, wrong term of there, is a fixed interest rate. So you're not relying on, like the stock market we'll talk about later on, has definitely a varying degree of risk. Bonds are at a fixed interest rate, so you know what you're going to get. Okay? And then, of course, it does depend on the type of bond. Whether it is that you're lending your money to the government or a company. Okay, so lots of different types that you can choose from, and you, of course, will learn about that in more detail later. The type of return is going to be a fixed interest rate, either every 6 months or per year. Okay, so you will know that you'll get X amount, like in my example over here, you are going to get $50 every year just based on interest. All right, so those are bonds. Again, you guys are welcome to pause my video anytime if anyone needs to get caught up or if you guys have any questions. I also will highly encourage you, if you do have questions, you're more than welcome to email me. I will be checking my email periodically while I am gone. Okay. All right, let's continue on with stocks. Stocks are always one type of investment that kids have a lot of questions on. You will go through more detail. You'll take specific notes over stocks next class, but we'll just do kind of an overview today. If you own a stock, you have a share or a unit of ownership, whoopsie, in a company. Okay, so you're an itty bitty teeny weeny part owner of that company. You can help make decisions for the company. You have voting rights. You can go to their board of directors meetings. There's lots of things that you can do if you are a stockholder for a company. Now, stocks pay with dividends or through capital gains. Okay, so there's two ways that you can make money through having a stock. The first one, and probably one of the most popular ones, is that you earn a dividend. That just means that you are given part of the company's profits and you, if you have the share of stock, you're called a shareholder or a stakeholder. So that's when part of the company's profits are given to you, the shareholder. So if the company does well, they make lots of profit for the year, they divide that out. Now, it's not going to be a lot of money. When you guys look up stocks next class, you'll see that some dividends are like 10 cents, 25 cents. But remember that stocks are purchased in units of 100. So you wouldn't just get a quarter, you would get, you know, the 25 cents times the 100 share of stock. The 100 shares of stock. Whew. So that is a great way for you to make money. You don't have to do anything. You don't have to give them anything except your money, of course, and then they just give that back to you. Now, I should note that not all companies have to declare dividends. It can be their choice. They could keep the money and just invest it into the company. You'll see that later on when you guys do look up stocks next time. The other way that you can kind of make money from having a stock is by capital gains. And that is just simply that you are able to sell a stock for more than you bought it for. Commonly known as buy low, sell high. Okay, very, very common there as well. Now, the risk level for stocks is very risky. And that's just because you're depending on the stock market, and you're depending on all of the businesses. So not only are you depending on how well that business has done for the year, but you're depending on how well the economy is doing. So a couple years ago, when we went through a recession, our economy was doing very, very, very poorly. So that then meant that the stock market went down. Doesn't mean that you did anything. It just means that the state of our economy was not very good at that point. So it is very risky. It also depends on the stock that you purchase. And you will learn during this unit of the different stocks that do exist and how you can pick that risk level. Depends on stock purchased. There is something called a beta level, and when you look at that beta level, that will tell you how risky the stock is. So if that beta level is equal to 1, that means that it will do as well as the market does. It's very, very constant with the whole market. If you have a beta that's less than 1, it's less risky. You guys know that'd be one I'd want. And if it's over 1, and it can go all the way, I think, to 2 or 3, that means it's very, very, very risky, okay? Anything over 1 is what percent more it is risky than with the stock market, okay? So if it's a 1.2, it's 20% more risky than something that would be under 1, if that makes any sense to anybody. All right, now we're going to talk about mutual funds. I feel like mutual funds don't get as much publicity as stocks. This is really what most of you, if you do have investments later on when you grow up, I'm betting that the majority of you will invest in a mutual fund, okay? The way that a mutual fund works is that it pools the money, or let's say combines the money of several investors together to purchase a large amount of securities. And when I say in securities, it can be any other type of investment. So you might be investing in stocks or bonds or anything along that lines, but you're putting your money all together. So pretend that everybody in class here today gave Mrs. Sweet $100. Okay, I put all of your $100 together, and then I'm going to go out and buy a few stocks, a few bonds, lots of different risk levels, and I'm going to put our money into those different investments. The reason why that's a good thing, and you guys have heard this before, the don't put your eggs all in one basket type of thing, that's exactly what this is. You're not putting all of your money in Google stock or all of your money in a government bond. You're spreading all of the money amongst those investments. So the theory is if one of those investments go down, it's not going to tank all of your money. Okay, you'll still be able to make a profit because that one stock isn't where all of your money is. That's why these are so popular, is because people like that thought that they're not going to lose all their money. The type of return that you get is typically in the form of interest and dividends, depending on how your mutual fund is divided. The risk level for mutual funds is lower because of diversification, which is what I just talked about earlier, not putting all your eggs in one basket. And what is included, you get fund management, which means some professional is going to help you, which I think is always important because these things can be confusing. So there's nothing wrong with asking for help. You can always go to a company like Edward Jones or anything along that lines, and they will help you manage your investments. Okay, lots of different places that you could go. But this is going to have a fee. That's how these companies make money, is that if you make money, they make money. Okay, so I want you to know that you do have to pay those people that help you. Now, I should also point out that mutual funds cannot just be purchased on our own. You need to go out and find these companies to help you purchase them, because you and I can't just do this on our own. Now I'm almost to 15 minutes, which is my time limit for these videos, so I'm going to go ahead and stop this one. You guys can get all caught up, and then I will start a new video here in just a second.